Welcome to our offering webinar for the Southeast portfolio. So before we go ahead and get started, I want to go ahead and go through our disclaimer here and just remind everybody that we are not offering tax, legal, or investment advice. We strongly encourage you to do your own due diligence and seek your own counsel of professionals to help you go through all of the documents that we have here for this offering. For our investor dashboard, for those of you that are already set up in IMS, this is a live offering, and the documents that are there, the PPM, the OA, everything is there that you will need to be able to subscribe if you are interested. For those of you that are joining us for the first time or have not yet accessed our dashboard, if you go to our website at spartan-investors.com, that can get you access to the dashboard. And if you're still having trouble, go ahead and send us a message at investors@spartan-investors.com. So before we get started in the offering, I'd like to talk to you a little bit about Spartan Investment Group, kind of who we are, where we are, and what we do. So currently today, we have over 6,700 units in our portfolio, and those units are managed and operated by 43 employees, and that's split between our headquarters staff and our frontline teams at the property level. We currently have about 150 million of projects underway, from ground up developments to some of our more stabilized projects that are just kind of going along. We have over 200 active investors on a list of over 3,000 total investors. To date, we've raised 50 million of private equity, and we've completed 10 projects. So a couple of big news from 2020 is Spartan made the Inc. 5000 and actually the Inc. 500, because we came in at number 308, and the Inc. 5000 is the 5,000 fastest growing companies in America. And for real estate, we were actually number 8. And then we also launched our national brand for our property management company and our facilities called FreeUp Storage. And we're headquartered in Golden and Seattle, Washington. And here's a picture of our headquarters team. There's 25 in our headquarters right now. We got a bunch of job announcements out as we're growing so that we can increase our efficiency across the board and increase our portfolio. So let's talk about the offering. So this one is a fantastic offering consisting of 9 facilities in 8 different markets, and this is a value add offering. The total price for the properties are $30 million, and they do have expansion potential, which I'll talk at as I walk through the individual properties here a little later in the webinar. So let's look at a summary of the offering. So as I mentioned, there are 9 facilities, and those 9 facilities are spread out over 3 states, Florida, Georgia, and Tennessee. They consist of several land development opportunities. There's a total of just over 517,000 square feet. All of the markets have strong fundamentals. We have expansion and operational improvements at every facility to drive additional value. We have economies of scale with other Spartan properties. We are considering setting up another regional office in this area because of a couple of facilities that we already own, one that will be coming on later in the year that we're developing. So we'll be able to set some additional assets over there and get economies of scale through shared labor. This portfolio actually includes industrial flex space as well as some retail, and it has projected cash flow in the first year. So let's look at the offering. So this is a Reg D 506C offering, which means it's open to accredited investors only. The equity that we're targeting is about 12.9 million. And the debt that we're raising is 23.3 million for a total of 36.2 million for this raise. We have 2 classes of equity here, and I'm not going to read the individual numbers, but our Class B folks that are bringing $1 million or more get a 20% bump on all of the metrics from the Class A investors. The minimum here is still $50,000. For our folks that are interested in debt, the minimum is $50,000. You will get a point when we close. It's a 7% annualized interest rate, and the estimated term is 9 months. We hope to be out in 6, but we wanted to give ourselves some additional time just in case because of the 3 different states. This will be a first position deed of trust on the properties, and you will receive monthly payments. So our investor projections for a Class A share, which is the $50,000 share, I just want to highlight a couple of key numbers on this slide. The first is a preferred return of 7%. The second is an estimated tax loss through a cost segregation study and bonus depreciation of $12,597. Over the life of the investment, you can expect to earn approximately $15,000 in operating returns. And then when we dispose of the asset, there's another $30,000 that will come back to you for a total return of about 92.6% or an equity multiple of 1.93. So for the Class B folks that bring $1 million minimum, the numbers here are based on 1 million. So it will increase pro rata if you bring 2 million, 3 million, 4 million. But your preferred return is 7%. Your estimated tax loss is $302,250 from that same cost segregation study. Your total operating returns are just over $309,000, and the return from the sale is just over $731,000, producing a 104% return with an equity multiple of 2.04. For our debt folks, this will be an interest-only loan with a term of 9 months. The debt service coverage ratio right out of the gate is 1.0x, and that's due to just the value add nature of this deal with expansions and raw land development. The interest rate is 7%. You will receive automatic payments via ACH monthly. You will have a personal guarantee, and there was a question about the details of that. That personal guarantee will be loaded on the drive, and this will be a first position deed of trust. So let's look at the feasibility analysis for this deal. The way that we positioned this on the webinar was to try to convey the most relevant information. The feasibility on this with 9 different cities was quite robust, and we could literally spend 4 hours going through all of the feasibility. The OM has additional feasibility that goes into greater detail, that go into individual markets, but for here, we just wanted to run through the high level markets by state and then just looking at the individual properties. Each one of these properties is named for the city in Florida that it's in. So for Florida, everybody loves Florida. It's the 3rd most populous state. People are moving there like crazy. The unemployment rate is low, and there's a lot of major industries there. And we have 3 facilities there in Ocala, Hudson, and Polacca, Florida. And as you can see the numbers here, they all have good, solid demographics across the board. At Polacca, even though the population growth is a little bit low, that the expansion that the seller just put on the market has leased up in a very, very short amount of time. So moving on to the state of Georgia, again, a very good market for storage. It's home to 17 Fortune 500 companies. Again, a lot of people are moving to Georgia. The Southeast is really a mover market. There's strong growth in all of the state's healthcare-based businesses, and like Florida, Georgia's unemployment rate is lower than our national rate. There are 5 facilities in Georgia. There is one in Columbus. That's the home of Fort Benning, a long-lost home for me as an infantry guy in the Army. There's Fort Oglethorpe, which is just kind of north Georgia, just south of the Tennessee border. There's Fortson, which is just north of Columbus. There's Lake Park, which is just north of the Florida border. And then there's Warner Robins, just a couple hours south of Atlanta. And again, you can see where we're planning expansion at 4 of the facilities, and I'll talk a little bit more about that when we get into the facility by facility. The last state is Tennessee. So again, a good market. Our Centerville storage is just outside of Nashville. You can see down there that the subject site has lower occupancy than the market, and that's due to the facility grade of being a C-. This one just has not been kept up and has kind of been not abandoned, but definitely not paid attention to. And I'll talk a little bit more about our plan to turn this around. But like Florida and Georgia, Tennessee's unemployment rate is lower than the national rate. There's a lot of people moving there over the last 9 years. And there's, again, just like Georgia, there's strong growth in the state's healthcare-based industries. So let's get into the individual projects. So the first one here is Polacca, and that's in Polacca, Florida. So Polacca is one of my favorite ones in the portfolio. As you can see in the pictures, that's the brand new storage that was just brought online in 2020. They did a fantastic job. It's been thoroughly reviewed, not only by the Spartan due diligence team, but also by a third-party due diligence team. And it's a fantastic facility, and they leased it up It's, I believe, in the 90s, and there's definitely demand for a lot more. The bottom right-hand side, you'll see that Polacca comes with some industrial flex space. In the market, there's less than a 2% vacancy for that space. And in addition, the Polacca facility comes with a lot of additional land. So we plan to not only add storage, but to add some industrial flex space, because ours is currently 100% occupied at about 100% below market rents. And we've underwritten not 100% gain in rents, because we wanted to be conservative here, but we've underwritten a 20 to 30% gain in rents there just to be conservative, because we really don't know where the market for rents there, but we're definitely going to try to find it. So the next one is in Ocala, Florida. So Ocala, Florida is just southwest of Polacca by maybe an hour. And Polacca is kind of in the middle of the state. This facility is a combination of, call it Gen 2 and brand new conditioned space, very similar to the build at Polacca. This one is leasing up very fast and is a good looking facility. It also comes with some retail in that top right. There's also some residential leases that come with this, and there is a piece of land that comes with this. However, we don't know yet if we can develop on it, because it's going to be kind of a hard entitlement process. It's not something that we're afraid of, but it's not something that we wanted to underwrite, because for us, the probability wasn't 100%. So this development could absolutely be some icing on the cake for this deal. We just didn't want to promise anything that we didn't know 100% that we could do. Let's continue to go to the southwest in Florida to Hudson. And I'm super excited about this deal, because this property comes with 2 parcels of land that sit on State Road 52 with over 30,000 vehicles per day. As kind of a metric, 15,000 vehicles per day gets retail people spun up. So we've got almost double. And in speaking with the county and the city, they are really interested in developing this side of Hudson. And they've already told us they'll be really flexible. And as we go to the pictures here, you can see in the bottom right-hand corner, it's a very large site. That picture is oriented to the north being on the bottom, and our site is right there, kind of in the middle of the picture. And it includes some retail, it includes some storage, some outside storage. It gives us a lot of opportunities to redevelop this site, because it's massive and we have a favorable jurisdiction for development here. So this one is definitely going to present a lot of opportunities as we come up with the redevelopment plan. The current plan as underwritten is just to let it operate, because it is cash flowing. So there's no reason to do anything for it right now, but we're definitely paying attention to what we can do in the future. Our next one is Fortson, Georgia, as we move north. And Fortson is just about 30 minutes north of Columbus. And Fortson is an expansion potential, and it's an operational and capital improvements potential. It's a good, solid facility. You can see here, we don't have that many capital improvements, fixing some doors, some drive aisles, and expansion here. The next one, we're going to jump even further north to just about the border at Tennessee, and we're going to look at Fort Oglethorpe. This is a very similar facility to Ocala in that it has some Gen 1 parts of it, and it also has brand new climate controlled expansion, as you can see in the bottom right-hand picture. In addition, there is the land that you can also see down there, and we've also talked to the city, and they've let us know that we could do some additional development. This is a brand new C of O that we're trying to go ahead and start the lease up. So we're not planning on developing it right away, because we want to see how this lease up goes. So the next one we'll talk about is just south of Fortson, and that's in Columbus, Georgia. This one is the home of Fort Benning, which is the Maneuver Center of Excellence for the United States Army, where the infantry and armor schools are. I can tell you, as a graduate of the infantry school, that base isn't going anywhere. So we have a very stable client base that is constantly rotating. In addition to a major maneuver base, there's also multiple training units there in Columbus. So we're really excited about this one from a stability aspect. This one is just operational improvements. We're going to get in there, put our FreeUp brand and our brand standards on this facility, and just increase the performance of it. There's very few CapEx, there's no expansion, and it's just going to be a good, solid facility to partner with Fortson just up the road a bit. The next one is Lake Park. This is in the south of Georgia, just north of Florida. And Lake Park comes with retail and storage. In addition to having a very large parking lot that's not being used and some land in the back. So we do have some expansion potential here at Lake Park where we are planning to expand. As you can see here, this is a little bit older facility, so we just have some painting and door replacements. The drive aisles are in pretty good shape. Most of the roofs were in good shape, so really this is an expansion play and just bringing it up to our brand standards for FreeUp. The next one is Warner Robins, just a couple of hours south of Atlanta, in an MSA that we actually know pretty well because we had a facility here that we transitioned to another buyer because it was a little bit too small for us. We actually have an opportunity to purchase that facility as well and bring additional operational improvements here. But again, this one is just fixing some broken doors. It'll be paint. You can see that the drive aisles have been paved. This is an expansion play, and the current owner has put a really good manager here to kind of clean it up from when they got it. There's still a little bit low occupancy here, and it's just because they were just kind of cleaning it up, getting the bad tenants out, and kind of doing a value add turn play. And we'll continue those same value add only with our FreeUp brand standards. And the last facility in the portfolio is in Centerville, Tennessee, about an hour and a half southwest of Nashville. So as you can see, this facility needs some work. This facility has been pretty much neglected, fixing the doors, fixing the drive aisles, getting some good solid marketing on it. The market is well occupied. So we actually think that of the operational improvements, Centerville offers an awful lot of opportunity for us to get in there and professionalize the place with the FreeUp brand standards and our capital improvement team to really kind of turn this around and increase the reputation in the community. So let's talk about our improvement plans. The first one of our capital improvements. So across the entire portfolio, we're going to have to do some drive aisle repairs and recoat for a fresh look so that when people pull in, it's that nice solid black asphalt look, just really clean, looks like somebody cares about the facility. You can see in Centerville, that would make all the difference in the world, that aerial photo. We'll repair all roofs to ensure our units are leak free. Again, some of these facilities are a little bit older, so we're just going to go in and repair the roofs. We'll renovate the office to our FreeUp brand standards to provide an enhanced experience to our customers, and we'll add self-storage retail goods as an ancillary revenue service. We'll repaint and repair all of the building damages, including doors that are non-operational, and any of the security cameras that are too old, we're going to replace them with new modern systems, and all of the facility will get rebranded with enhanced signage in the FreeUp brand. So you can see there's our trademarked logo for FreeUp Storage. So each of these facilities and every facility in our portfolio and every facility to come will be rebranded to FreeUp. We are going to increase the rents to market rate. And then through FreeUp University that is built within Spartan Investment Group's learning management platform, we're going to increase the staff training to enhance the customer experience. And then according to our FreeUp brand standards, we will develop community partnerships and business relationships in our various markets, adding additional ancillary revenue streams through tenant insurance, retail sales, U-Haul. We have a number of them that we can drop into place across the portfolio. So there's two services that SIG provides, and that's asset management is the first one. And asset management really is about understanding and keeping aware in your market, managing the life cycle of the facility to determine when to dispose of that asset, and managing the financial levers to understand your revenue sources, your expense sources, and also your debt sources. And the last part of asset management is to manage liability through our insurance and to ensure that the properties are properly insured for whatever could happen. The next service that SIG provides through our FreeUp brand is property management. And a key part of property management is revenue management. So we use a system called Storage, and that has a revenue management platform very, very similar to the airlines. We have it set that when certain unit sizes get to a certain occupancy, it will automatically increase the price. Marketing, we are standing up an internal marketing team to make sure that we are doing everything we can, both from a digital perspective and an analog perspective, to drive as many customers as we can to each one of our properties. We have in-house maintenance staff to ensure that the doors are not broken, that our gates are working properly, and our roofs are not leaking, so that we have the highest customer experience we can at every single one of our facilities. And then while self-storage is not as regulated as some of the other asset classes, there are regulations. So that our property management teams ensures we're in compliance, especially with auctions, which is a huge benefit for storage. However, there are processes and procedures state by state that you do have to follow. And with that, I'm going to turn it over to Spartan's Chief Financial Officer, Ben Lapidus, to take you through the numbers.
Thanks, Scott. Well, folks, before we get started, just know that our underwriting file is accessible both at the portfolio level as well as the individual property level. All of our assumptions are in that folder. Hundreds of data points go into each assumption, and each data point is backed by research from our feasibility team. As we look at the first slide here for our financial projections, there's a couple of items that I want to call out, and there's a lot of numbers here, so I'm just going to read them for you. The first being that our revenue is growing from 2.6 million to 3.9 million in the storage rents. And that's coming from two places. The first is increasing our collections on our current cash flow and expanding the facility. We're increasing our collections by over 59% in our underwriting. Where does that come from? We're projecting a 10% shift in rates from our current street rates to current market rates. That means that based off of our evaluation of our competitors, after we boil the frog with some capital improvements, we'll be able to push our rents by approximately 10%. Right out of the gate. But we're increasing our collections by 59%. Well, part of that is increasing the rates, but the remainder of that is increasing occupancy on the units that were recently delivered in the expansion from the last owner, as well as increasing collections on current units. There are folks that are paying half of the current street rates. So getting those units to pay, getting delinquent units on track to pay, the full street rate is going to be a lot of our operational improvements. A 59% revenue increase is a big lift. And that's why we look at this as a value add play. But we know it's something that our team can do because when we've purchased portfolios before, we've gotten it done. And that's based, again, from our hundreds of man hours of research, both on the ground and digitally, from our feasibility study, personally visiting every facility, doing rent surveys, calling competitors. The other item that I want to call out here is the debt service. So in the beginning, we mentioned that the debt service for our private debt folks, the debt service coverage ratio, is 1.08, and that is from day one. But by the end of the first year, we're going to be at a 1.7 debt service coverage ratio. Where does that come from? Once again, that comes from our ability to increase rent collections. That's not going to come from our ability to expand, not in the first year, but with such a wide ability to push collections, we can get our debt service coverage ratio up to a very palatable place very quickly. And we have proof of that. We have a less professional owner that's currently operating this. And over the last 90 days, since we've went under our LOI, they have increased their collections by over $29,000 per month, which is over 12% of the baseline of where they had started, just in 90 days. So we're very excited to take this over and get that debt service coverage ratio up. You'll also see the property taxes. Property taxes is the biggest expense lever to be looking at in commercial real estate today across every asset class. In the first year, we underwrote $125,000 in property taxes because that's where they currently are. By the end of this thing, we've underwritten $528,000 in property taxes. And a good chunk of that comes from the fact that we're adding 89,000 square feet, and we don't want to assume that the county's not going to know about that. They will. But the majority of that is, once again, from rigorous research, working with property tax accountants and attorneys to determine what our property taxes will be on our current square footage. And we've underwritten it to more than triple. So we believe that we've got some conservatism here, as well as an understanding of how aggressive we can get in pushing our rents. What I want to point out is that our terminal cap rate is 5.8%. Right now, nationwide cap rates are about 5.65%, and we usually lag by about 3 to 6 months in knowing where cap rates are. Cap rates compressed in the previous 6-month period to where we knew about by 35 basis points just in a 6-month period. And that's coming from a supply-demand shift in the storage space. Storage is a really attractive investment class for real estate investors right now because rents just keep going up despite what seems to be happening in the global health crisis and the global economy, whereas other asset classes have been hurting. So investors who are looking for stability are shifting their dollars here. And we've seen the largest push in institutional capital in the last 6 to 8 months than we ever have in this industry, with Blackstone, Bill Gates, Singapore Sovereign Fund, and Public Storage, the largest owner, deploying billions of dollars in acquisitions in the last 6 months per entity. So a lot of people ask us, how are we going to hedge against shifts in interest rates, adverse shifts in interest rates? Well, We've seen over the last 30 years that regardless of how interest rates shift in the short term, as when they spike sometimes, the spreads just compress between interest rates and cap rates in storage. Over the long term, spreads continue to go down. And we believe there is still more room for interest rates to go down and the spreads to go down. So two levers to continue to compress cap rates. That being said, our terminal cap rate of 5.8 represents an expansion of underwritten cap rates. So we're assuming an annual expansion of cap rates every year. And ultimately, by the end of our year 5 projections, we get to a $56 million valuation, which on a $40 million cost basis is a decent spread. So even if there was a major correction from an adverse shift in interest rates or some other black swan event, we have a solid cushion of value spread to protect our principal. The other thing I want to point out is the cash flow. So in the first 2 years, we're looking at about a 4% targeted cash flow. This is because we're looking at increasing our square footage by 89,000 feet on a current 320,000 square foot. So about a 20 to 25% increase in footprint. We need more debt to be able to do that expansion, and that consumes some of the cash flow. But by the end of year 5, we are well over the 8% mark, approaching 9%. And because we've only underwritten 89,000, if we do determine that we want to underwrite more, that we do want to pursue more, we want to pursue hundreds of thousands of square feet of expansion, by year 5, we could be in the double digits of cash flow. But we only wanted to underwrite what we knew today, what we had our arms around today in terms of expansion. So just to summarize where we're at, there's 3 ways to invest. You can invest as an equity member or a debt member. And as an equity member, there's Class A membership and Class B membership. The minimum for Class A is $50,000, while the minimum for Class B is $1 million. Each $50,000 chunk of ownership for a Class A member will be about 0.2%, just a little bit less. For Class B members, it's about 24 times that, despite requiring 20 times the amount of capital. So for a 20 times increase in capital, there's a 24 times increase in ownership for 4.65%. Both have the same preferred return, and preferred returns are distributed pro rata between both members. So regardless of scale of investment, the preferred return is distributed equally per dollar invested. Once we get beyond the preferred return, the returns are not distributed equally per dollar of investment. They are distributed based off of ownership amount. So for Class A members, we're looking at total cash flow of $15,000 over the first 5 years with a liquidity event that produces $30,000 of upside. So the total upside for Class A members is $46,000. That's an equity multiple of 1.93 times and an annual return of 18.5%. That's an annualized total return of 18.5%. For Class B members, on a $1 million investment, we're looking at $310,000 of cash flow over the 5 years in aggregate, $730,000 of upside from the liquidity for total upside returns of over $1 million. So more than doubling your money over the 5-year hold with a 2.04 equity multiple and a 20.8 annualized return, 20.8% per year annualized return. So whenever we underwrite an investment, we look at the likely scenario, which is our targeted returns, but we like to also bookend it with a worst case and a best case scenario. So our target annualized returns for Class A members is 18.5%. There are a number of variables that we tweak in our underwriting file that if you were to open it up, you could see what those are. But the heavy ones are maximum economic performance, assumed market rate increases, cap rates, and hold period. Those are the biggest levers in our sensitivity analysis. And when we pull those levers based off of the most likely 98% confidence level, everything barring a black swan event that we can determine today across different types of risk, we're bookending our annualized returns for Class A members between 13.1% in our worst case scenario and 26.8% in our best case scenario. We have a total raise of over $36 million. The minimum investment is $50,000. If you're looking for a 20% equity premium, which drives about a 13% overall total return premium, then the minimum is going to be $1 million. Class A members have a targeted annual return of 18.5% over the 5-year hold with a 7% preferred return. Class B members have a targeted annual return of 20.8% over the 5-year hold period with a 7% preferred return. Debt investors, we're paying a 7% annualized return paid monthly with 1 point at closing. This is open to accredited and sophisticated investors. So the last thing I want to walk you guys through is how Spartan makes money. It's important to have transparency. That is one of Spartan's great values. On the sponsorship side, which is how we make money outside of our service offerings, there's two types of fees. Our acquisition fee, which is based on total project cost. That's 2.85%. It's one time paid at closing on the total project cost, inclusive of everything, including the purchase price. Our development fees are up to 10%. That's just on anything that we expand. So that is for us putting together the deal when it comes to expansion or improvement costs. That's not on the purchase price. On the sponsor services side, these are fees paid only in lieu of a third party. When a third party isn't present to produce these things because either they don't exist or because we don't believe they have the same incentive alignment as Spartan, we believe that Spartan can produce better returns for our investors. These fees are charged to Spartan instead. That is a 6% property management that's based on gross operating income paid monthly. A 1/4 point of asset management, that's on total project cost. That's a 1/4 point per year. 2% disposition fee, again, only if we act without a broker. If we are able to identify the seller ourselves, we take a 2% listing fee, disposition fee. Up to 10% general contractor fee. This is paid not to Spartan Investment Group, but to Spartan Construction Management in line with industry standards. And a 1% financing fee. Again, if a broker is not used, there's up to a 1% financing fee for securing the debt, regardless of recourse or non-recourse debt. So with that said, this is the end of our presentation. We're going to start going through questions, but next steps are, if you haven't met Ted Green and Ryan Gibson and Lauren Breichel, you definitely want to have a conversation with them. You can email investors@spartan-investors.com, and one of the three will reach back out to you. This offering is on a first come, first served basis. So email us, log into the investor portal, review all the offerings, like all the documentation that we have for the offering. And if it's something that you're interested in, you're going to want to complete your accredited investor verification and offering documents at your earliest convenience, because once it's full, it's full. Once all those documents are completed, you're going to subscribe, fill out the subscription agreement. All of that is done through our investor dashboard. You'll receive wiring instructions on our dashboard. You will not receive anything from us by email. If you have any concerns, please call us. Please do not wire anything based off of information you receive by email. And then once the wiring is received, we will confirm, and you will be sent corporate documents expressing your ownership in the deal. And in the first 3 to 6 months, you will get your first distribution based on performance. With that said, that is the end of our presentations, and we're going to start looking at questions.
So one of the questions was, what is the split? The current split is 50-50 SIG to the limited investors. And depending on how many Class B members come in, because there's a 20% bump that comes up with there, it could go up to 40-60 SIG to the limited members. Is there a pref? We talked about a 7% preferred return. There was a question about how we came to a 7% for this deal. When we look at the market out there for deals that are like kind of this across a private placement ecosphere, 6 to 7% for this type of deal is what is market standard. So that's where we came up with a 7% preferred return. Spartan had money in the deal. We have money in every single deal, in addition to personally guaranteeing the $23 million worth of debt. What is the projected timeline? This is a 5-year deal. How will you sell these 9 properties individually or as a portfolio? And what is your exit strategy? I'm going to talk to both of these at the same time. So for every single deal we do, we come into it with multiple exit strategies. So the answer to the first question, individually or as a portfolio, is yes. If opportunity knocks, we'll open the door. In addition, we could recapitalize this project as we move through the business plan, and it moves from a value add to a core plus. That recapitalization could take out current investors with their returns and bring in new investors. It's a very common occurrence in value add to core plus plays. So again, we do have multiple exit strategies here. We could also just reposition the portfolio to core plus and just sell all 9 facilities. Again, we could sell 1 or 2 or 4 or 6, whatever necessarily happens. The preferred course of action is to recapitalize these and bring them into a stabilized storage portfolio. How has SIG accounted for the increase in construction costs across the portfolio? So with our in-house construction management group, we are collecting data from the market on our various projects right now. And prices are moving all over the place. We had one project that was going to be constructed of wood. We had to switch to steel because of costs, but we were still able to get it done. So we, like everybody else, are doing the best we can, leveraging the last 3 months of data to project into the future. Have property taxes been accounted for? Ben addressed that during the financial part. What type of insurance does SIG provide to the properties? We have full scope A-rated insurance covering anything from riots to weather. So we are fully insured at every single one of our properties. Will you be conducting cost segregation? We conduct cost segregation on every single one of our properties. Storage is a fantastic asset class for cost segregation. Will I receive a K1 for each property? No, investors will only receive one K1 for the entire investment. Do you manage your own properties? Yes, we do, under the FreeUp management brand. Third-party storage is often quoted at 6%. The real cost, when you shake everything out, is about 10%. SIG only charges a real 6%, and we don't trust anybody with our investments as much as we trust ourselves. So we want to manage our own facilities. Is pref cash on cash pro rata between Class A and Class B? Yes, it is. What is the tolerance for raising lease rates and occupancy if they were to decline? Our leverage break-even occupancy is about 72%. So we underwrite artificial economic ceiling at 89%. However, the market is underwriting that economic ceiling 91, 92.
95.
Some of the REITs are 95, so they're really aggressive. We have conservatism baked into our underwriting all over the place, to include some expansion projects that we think we can do, but we're not going to put them out there because they will require threading of the needle with the jurisdictions in order to get them done. So we didn't want to underwrite them. But again, as I mentioned, they might just be icing on the cake. So moving from the equity questions to the debt questions, will the loan be secured in the first position? Yes, it will. Interest rate, 7%. Loan term, 9 months. Can the loan be extended? Yes, it can. 1 point for 6 months. DSCR on the loan, day one is 1.08. This is a partial lease-up deal, so that DSCR will be changing all the time at hopefully an expanding rate. Who is performing the construction? That's Spartan Construction Management. We are building out that team. We have a licensed general contractor on staff. We also have our director of construction that came from Casey Industrial, and they build big power plants. And he was the key project manager for a massive renovation of the entire ventilation system of the Eisenhower Tunnel here in Colorado. So he is well versed in the art of construction, and storage is much, much easier than some of the very complex projects he's put together. Will the loan be personally guaranteed? Yes, by myself, Mr. Lapidus, and Mr. Gibson. Can the principals cover the debt coverage if something goes wrong? We have multiple ways of providing additional collateral if needed to make sure that happens. That is spread over 9 properties, which is a good risk mitigation thing here. So the probability of all the debt not performing is very, very low. What is the exit strategy for the loan? Hopefully in 3 to 6 months, it'll be refinanced by a local bank. Ben and I met with a bank yesterday that is interested in financing the whole deal. So we're already having conversations with multiple lenders that are interested in this. That's to say, the next question, is there a risk that the refi of debt will be delayed or prohibitively expensive? We already have some kind of initial quotes and some initial interest on this, and we haven't even closed on the property. So we believe that we'll be able to do this in 3 to 6 months. If I participate in debt, what kind of tax document will I receive? You will receive a 1099 INT. Why does Spartan need the loan? Well, technically, we don't need the loan. However, out there in the storage market right now, as Ben alluded to, there's a lot of big players in there, and they're coming with cash offers. So in addition to being able to come in and play with the big boys and get these really solid deals by coming in all cash, we also don't want to be in the position where we're rushing into debt. So by allowing the private debt, it gives us the flexibility to get the right debt on the property. Is there a deed of trust and promissory note? Absolutely. The loan documents will be on the IMS portal for your review. How do I move forward with the investment? Going back to the front of the presentation, if you're already in our IMS system, the offering is live and folks are actively subscribing to it right now. If you are not currently in our IMS system, please go to our website and you can get to it there. or you can email at the email on the screen right now, investors@spartan-investors.com, and one of our IR team will follow up with you.
I'll read this. Is this an accredited investor offering only? If we are a sophisticated investor, do not qualify as an accredited investor, can we invest? Ted, you want to take that?
Everybody, Ted here with Investor Relations. Under 506C, which is the exemption we use for our larger offerings, we use the accredited investor only for the hurdle. The sophisticated investor is eligible for a 506B, but for 506C for Charlie, only accredited investors.
All right, thank you.
Thanks, Ted. From Scott, can you provide average income for these property locations so we can compare to the median? Yes, we can. We will follow up with that information and determine if we will put it on the portal through some other document, because usually that is in there. I think the reason this wasn't immediately available in our offering memorandum, Scott, is because there's just so much data on 9 properties. We were trying to pick and choose without creating a 400-page document. But yes, we can definitely provide that.
So Jeff is asking whether he should invest in more self-storage or not. That's really getting into the advice situation. So Jeff, you've caught me in kind of a catch-22 here. Spartan loves self-storage. However, the answer to that question is very much personal to you, and I can't really advise you on that. What I can speak to are the advantage and potential of storage units. Storage is considered a recession-resistant asset class because whether it's good or bad, people need a place to put their stuff. And it's not just grandma's old rocking chair. We have a number of businesses that leverage our units for last mile logistics and inventory storage. Those uses aren't going away, and those businesses can really look at getting the arbitrage between their retail rents and storage rents, which in some markets can be $20, $30 per square foot on an annual basis. So Jeff, I hope I've answered your question there. I don't really feel comfortable giving you advice because I don't know your personal situation, but Spartan loves storage and so does Bill Gates and Blackstone. So I don't know if those help you or not, but if you have more questions, I bet you Ted will sit there and talk to you till both of you are blue in the face about this.
Awesome. So our next question is, real estate prices have been out of control. How does your acquisition dollar per square foot compare to acquisitions made in 2019? The prices are based almost in line with the market, how risky that market is deemed to be, but even more importantly, what the average rents in that market are. In Ada, Oklahoma, the rents for climate control are $6. In Vail, Colorado, the rents for climate control are bordering on $40 per square foot per unit. When you've got that big of a disparity in rents, your disparity in dollars per square foot in an acquisition are going to follow. So a lot of our acquisitions were not in the Southeast last year. In fact, our first acquisition in the Southeast was in December of 2020. So we don't have comparable data. What I can tell internally for Spartan, what I can tell you is that we are purchasing this. When you look at the retail, the industrial, the storage, we are purchasing this. I don't know this exactly offhand, but I do believe for under $80 per square foot. And as a absolutely absurd benchmark, Public Storage did just buy Easy Storage not even 60 days ago, which is a DC 48 property portfolio, and they purchased it for over $400 per foot. We have purchased assets as low as $23 per foot, which were falling over, and we have purchased assets $100 and over per foot that were very nice. We have assets that today are worth more than $150 per foot. We would not sell them for anything less than that. So it really comes down to what is the condition of the asset, how much capital improvement is required, what is the cap rate of the market that it's in, and what are the rents that you can get there in order to compare apples to apples. I hope that helps. Will this portfolio be broken up for later for selling?
So Leah, great question. And the answer is, I don't know. So when opportunity knocks, you got to answer the door. There's a lot of different things that we can do with this, and to try to predict the future and set a course of action now, even before the expansion of the various facilities, I think would kind of pigeonhole us into something that maybe we don't want to do. I know it's not a very definitive answer for you, but that's we believe that that's one of the really awesome kind of features of this portfolio is we have a lot of different options here. We could sell a one-off in Tennessee. We could sell a 5-property portfolio in Georgia. We could sell a 3-property portfolio in Florida. We could sell one of the Florida properties and one of the Georgia properties. There is just an innumerable number of options that we could do here.
Some of your markets have weak demographics. Any thoughts about exiting those facilities early? And or how do you plan to mitigate these issues? So there are some markets that have some data points that are not inside of our ideal box. But what's interesting is the ones with the worst population growth numbers have the highest market occupancy. So, we look at the collective when determining what is attractive about the entire portfolio. Are we open to selling these facilities early as individuals? Absolutely. As Scott just mentioned, everything is on the table when it comes to the exit plan, but we're just seeing so many portfolios trading at such a low cap rate, and with assets that are kind of intermixed with high quality assets and low quality assets that are way worse than anything in this portfolio, that we struggle to see at this point in time, as of today, we struggle to see the value of breaking the portfolio up, but we are very open-minded to it. What will trigger a disposition? This is similar to the last question or the last couple of questions. There's a couple of options on the table. One is Spartan has a number of assets that we would eventually like to roll into a homogenized capital stack, meaning a singular fund, whereas everything right now is deal by deal. So if that event occurs, there might be a recapitalization, which is different than a disposition, where investors in this deal have the opportunity to exit at the appraised value of the portfolio. The other option would be to sell because we are approached by one of the 50 to 80 companies that are larger than Spartan Investment Group right now, the top 20 to 30 of which are starting to have massive amounts of investment being poured into them, billions, tens of billions of dollars, and they are hunting with very aggressive pricing. We don't expect that to go away. We don't expect that to be a short stint. We expect that to really just get started. So if we get approached, then the portfolio could be picked up much, much sooner than we anticipate. Otherwise, we're going to be looking for completing our business plan and squeezing every little bit of juice that we underwrote or that we haven't underwrote but have identified along the way before we exit the property. Will Class A investors be impacted by the number of Class B investors or vice versa? The answer to that is no. If you would like, I'm not sure who this is, but if you would like more information on that, we can share the math with you. But holistically, the number of Class A investors versus Class B investors will not impact it. The extra oomph that Class B investors are getting is not coming out of the value from Class A investors. It is coming out of Spartan Investment Group's upside, 100%. We've already answered the management question. We manage all of our own properties. In general, how does self-storage compare to multifamily real estate investments in terms of risk and return? Ted, I don't know if you have any input on this. We are not multifamily real estate investors, so I don't know that I want to speak to this.
I also think that this is another personal question. It depends on how you look at risk and return. Again, as Ben said, we're not multifamily folks. I can tell you that during the pandemic, there were lots of stories about apartment landlords. There wasn't any stories about storage landlords. So when you look at the regulation, my personal opinion, there's a lot more regulation around the multifamily than self-storage. And it just really depends on kind of how you look at your risk and return. Ted, did you want to add anything to that?
I think a good rule of thumb when you're looking for resources in this category is to find the Yale Endowment annual report and just peruse through the asset classes that are exhibited in that annual report, and then do your best to emulate that asset allocation. Now, you're not going to hit a bang on, but spread the net far and wide is my assessment.
Integra Realty Resources is another good data provider. I'm not sure who they were just bought by, if it was RealPage or CoStar, but IRR is a great data provider for different asset class risk and return numbers. If we refinance, will the preferred return be based off of the original investment amount or the new remaining capital contribution? So it is the latter. The preferred return is based off of your outstanding capital contribution. So if there is a return of capital, that will reduce your investment remaining, and the preferred return will be based off of that new remaining capital. That being said, preferred returns in the first along the way are not treated as return of capital. They're treated as return on capital. So any distributions from cash flow, preferred return, or upside will not reduce your contribution balance, your capital account balance. Do we have institutional or other large private lenders? We have a number of banking relationships, both in local banks. We have worked with debt funds. We've worked with life companies. We are working with a credit union on another deal right now. We have gone the entire spectrum. We've gone down the CMBS rabbit hole. We have brokerage relationships with probably over 50 brokers at this point, where we've selected our top 3 to 5 that we enjoy. We use private debt for the reasons that Scott mentioned earlier. We don't have to dive into that. We do not work with institutional bridge debt for acquisition purposes today. With the low debt coverage in the early days, makes me wonder about default provisions, lenders' propensity to cause trouble. So the only lender in the mix right now is going to be our private debt folks. When we do refinance these individuals out, we have, like we just said, David, a number of relationships. We've got a couple of folks that have enjoyed working with us so much, they're starting to really court us for more business, larger relationships. So we have gone through notes and deeds of trust and warranty deeds with a fine tooth comb. We were just doing one this morning, 60 pages, Scott and I were doing this morning. We've done this a lot of times. We have our standards, we have our box. We know what to say up front to make sure that we're starting down the right path with the right lender in advance. And when lenders look at an economic occupancy based off of potential future rental income that's at around 50 to 60%, they are very understanding of a lower debt service coverage ratio. A 1.08 day one debt service coverage ratio is not unattractive when you've got brand new buildings that are empty, and they're empty because they've been open for 4 days. So lenders do understand that, especially the local banks. They are reasonable. How will you segregate the Georgia profits on the K1 as the other 2 states have no state taxes? So you will receive 1 federal K1 and you will receive 3 state K1s for your accountant to process. How will you finance the expansions? There's a number of ways that we can do this. The first is we can go to the same bank that's providing our permanent debt, and we've done this a number of times, and we say, hey guys, we're doing really well, here's our performance, and provide us the same terms and provide us construction debt with an IO period, interest only period on the construction, and we work with those banks. We're doing that right now. If anybody's in Battlefield Self-Storage, we're working with the same bank to do our improvements in our conversion that provided the permanent financing on the existing structures. So that's option number 1. Option number 2 is we do this again. We have another raise conversation and we say, hey, we are doing an expansion. We would like to raise a small amount of funds that is secondary to our primary debt to expand the facility. And then once we get our certificate of occupancy on the new structure, we go back to the same bank and we get an expanded line on our permanent debt. Will you split the improvements in goodwill to lower the property taxes? Brian, this is something that we've explored a lot. And it's not something that this particular seller is open to. How will the relative performance of the properties affect the disposition of a particular property? Will the performance of asset A affect the disposition of asset B? If they get sold individually, no. If they get sold as a portfolio, yes. The performance, if NOI drops on asset A, then the overall portfolio will be sold for less money, but it won't necessarily affect cap rates, the particular performance. Next question, Aaliyah, was this originally one owner for the whole portfolio? How long did they own the properties? So the current seller is one owner. They were aggregated from a series of previous sellers, previous owners for each property. They've owned these properties anywhere from a few months to only a couple of years. So they have not been under management for very long. So this is a accumulated portfolio. It's almost like we went to direct to a seller, to mom and pop operators, but we have an opportunity to buy 9 at the same time and do the work all at the same time because somebody else aggregated these for us. The follow-up question would be, well, what was the cost basis that this person had? And when we look at how much they actually put into the properties, after their purchase price, which we do have access to, their cost basis is well in excess of $20 million. So they have pushed rents quite a bit since only a few years ago in the short time that they have. And we've personally experienced this where we've purchased a portfolio and our rents are up by 25% in the first 6 months. So it's not unheard of to be able to push that kind of value in such a short period of time when you're taking over from mom and pop operators. That being said, this is a newer aggregator of self-storage, and we believe that our operational ability exceeds this current owner. They had just employed a regional manager from Public Storage during our due diligence process, which indicates that they were really still kind of getting their stuff together when it comes to operations. Can you talk more about FreeUp setting up a regional site in the Southeast to provide more direct management to this portfolio? Scott?
So we have explored a couple different opportunities here. Again, we have properties right now in Georgia and Arkansas, kind of already in the Southeast. We are in partnership to build another one just north of Atlanta. So we have looked at courses of action of establishing a regional manager in Atlanta to help facilitate a more on-the-ground approach to the management in this region. We do have a regional manager for our Texas properties, and that person is able to then move staff around easier to create operational efficiencies. We have not decided where to put that manager yet. Atlanta is looking like the front runner for the time being, but no decisions have been made yet.
Aaliyah, you asked, will you do a refinance at any time, providing investors some of their money back? Will we do a refinance at any time? It is likely, but when you underwrite for a refinance, all of your returns look much better. And our philosophy is, as best as we can, to under-promise and over-deliver. So we don't like to package in refinancings unless the deal is contingent on that being done, and we've already established our game plan for that. We like to stay flexible, and so we don't want to dictate our refinancing timeframe or our refinancing milestone. And if we do refinance, in theory, it will drive up the internal rate of return for investors. But if and when we do, yes, we will be doing a return of capital. What happens to my investment? If you sell off part of the portfolio, you will get a return of capital that corresponds to the amount of money that was received for that investment. Gloria asked, will I be able to roll over debt from another deal that is in its closing process into this portfolio debt? I believe the answer is yes. Ted?
That's correct. So we've got, and Lauren, you might want to help me on this. We've got Marion Beavers coming up, and that is eligible for rollover. So yes, we're on track.
Awesome. Thank you, Ted. Will there be a replay I can share? The answer is yes. And can you share that replay? The answer is yes, because this is a 506c offering. Can we invest through self-directed IRA? That is from Ron. Ted, do you want to take that one?
Yes, we can. We are eager and happy for those dollars.
Where can we download a copy of the deck that you just showed on this webinar? If you have access to our investor dashboard, you can access the offering memorandum, which has all of these slides and more, with videos of each property, so you can take a virtual tour and be toured around by the very handsome on-screen Ryan Gibson, and as well as our underwriting file and all of our other information, private placement memorandum can be found on the dashboard. Historically, has Spartan hit their projected internal rate of return and equity multiples on recent dispositions? Brian, we are still building our portfolio, and our plan is to aggregate as much storage as possible before selling it off for a compressed cap rate as a portfolio. That is our primary course of action, not our dictated only course of action. But as a result, we have yet to dispose of any self-storage assets, with the exception of one, which we've recapitalized. Spartan still owns it, but the investors did exit, and we did exceed our project IRR on that one asset.
Brian, we did dispose of one asset. One of our self-storages came with the consolation prize of a car wash. We did not want the car wash, but it was by taking the car wash, it enabled us to get the deal. We underwrote that car wash to be valued at disposition at $650,000. We sold it for just over $1 million. So going back to the question about what happens when that happens, there was $1 million that was returned back to investors as return of capital about 2 years into a 5-year deal. That actually literally just happened last week.
And now that property is able to cash flow at 12%, which is fantastic. Beverly asked, if investing using solo 401k or self-directed IRA, would I be subject to UBIT and UDFI? Ted, you want to take that one?
So treacherous water here. There may be changes coming around the corner, so we can't anticipate any changes to the tax law. Typically speaking, UBTI and UDFI in solo 401ks are a non-issue, no Form 990T necessary. Looking backwards, anything can happen going forward.
Thanks, Ted. Ron's asking, if a person were to invest $50,000, what percentage would typically be attributed to bonus depreciation? So our cost segregation, on average, we estimate, we don't actually know until the cost segregation study is complete, and we can't issue it until we have acquired the asset itself. But typically 25% of the value is able to be bonus depreciated in the first year. So we estimate about $12,500, 20 to 25%. So Austin, you're asking about Risk here, again, when we start talking about risk, it starts going into investor preferences and guidance and advisory, and we like to stay away from that. But my personal opinion is that multiple facilities offers some great benefits to individual facilities when it comes to deal offerings that Spartan puts out. The first being is the share of expense load. We're able to share a regional manager, which increases the overall performance of the property because we have more professional management. We're able to share other employees when there are gaps in the employment. We're able to share on insurance efficiencies and lots of other expense stuff. So the overall expense load drops by way of having multiple facilities in a single asset. Additionally, if there were to be a blip in revenue in one location, we're able to support that blip with the other 8 facilities. So if you're asking about risk, there is some risk mitigation in there being a diversification of geographies here. Mohammed, you are asking a question about completing the subscription and process. If you have any questions about the process, you want to be just triple sure, you can talk to Ted or Lauren or Ryan. That's Ted at Spartan-investors.com, Lauren at Ryan at, or if you want a general response to get in touch with any of the 3, investors at Spartan-investors.com. What are some of the industrial flex space opportunities? What kind of renters take advantage of that?
So Austin, I'm going to try to knock out 2 birds with 1 stone because I can kind of see the bottom when you talk about retail space. So when you think about, I'll try to give you an example of an industrial flex. So I'll try to walk you through the visualization here that you walk into a tiny little office, and then behind that office is just an open warehouse. So there's just a ton of different uses for that. I'll walk you through 1, and I'll walk you through 2 here at the Spartan headquarters because we are in this space. It's why we love it so much. So the way that Spartan is using this space is you walk into our doors and there's a bunch of office space, and then you look back and there's an industrial bay. In that industrial bay, we've completely renovated it, put new floors in, painted it, blah, blah, blah. And all of our desks are out there and all of our collaboration spaces are up front in the office spaces. The previous renters here, the gentleman used the front office as office spaces, and they had a scientific warehouse in the back. It's all over the place. We've walked into some, and there was one that was selling like sports memorabilia. So they had all kinds of, fake football helmets and, random jerseys and stuff like that as inventory in the back that they were selling offline. So there's a million different uses for that flex space. That's why we like it. And the retail space is third-party renters, no FreeUp retail stores. The FreeUp retail stores are our storage offices.
How do you fix delinquent accounts? Are storage units on long-term leases?
Love self-storage, right? How do we fix them? We sell their stuff. And no joke, we do. So self-storage is not on long-term leases, it's month to month. There are called lien laws. So unlike a multifamily, you can just evict a multifamily tenant, but with storage, not only can you evict a tenant, but you can seize their goods through our auction process. So if we have accounts that are delinquent, of course, we try to work with our renters to fix those delinquent accounts. If not, then we have a service called late to lien, and we go through the auction process that we can recoup some of the money. Generally, it's not like the TV storage wars. We're not making lots of money on it. It basically just frees up the unit.
Can you just talk through weather risk a bit? Do those outdoor units get flooded often or damaged, and are you liable for what's inside? I'll start with going backwards here, but we are not liable for what's inside. Our tenants, we require tenant insurance. They can provide their own, or they can buy it from us. It is ancillary income for us. In fact, we've, in the last 6 months, have implemented new tenant insurance, and it has skyrocketed our ancillary income revenue across the entire portfolio. The outdoor units can get flooded, but I believe that's why they're constructed with a lip. Do you want to speak to the construction?
Yeah, so they definitely can get flooded, but it takes a pretty good storm event in order for it to do that. All self-storage units there is a lip just behind the door that's about 1.5 inches. And of course, if there's a massive storm event, the doors do have seals on the bottom in addition to that lip, but the massive storm events can cause that. All of our properties, we do pay attention to the grading of those properties and try to move the stormwater as best we can, but can they get inside? They can. But going back to what Ben said is no, we're not liable for that.
Are second floors difficult to build or manage? Is that a potential opportunity to increase capacity?
So this one's pretty complicated. Are they difficult to build? No. Are they difficult to manage? No. Do they command a little bit less rates? Sometimes. Is it a potential opportunity to increase capacity? If you're talking about installing a mezzanine level in an existing building, yes, there is. You need about 18-foot ceilings to be able to do that. But it is an opportunity.
I think the question might be about adding a second floor to a pre-existing roll-up single-story building.
Oh, no, you can't do that. The existing buildings that you saw in the presentation, there's no weight loading available to go up. They're just simple metal. There is structural steel for the building moving side to side or whatever, but there's not enough structural steel to put a second story on an existing building.
Do you happen to know what premiums you pay to acquire these facilities from previous owners? What kind of return do they get from the sale to SIG?
So I think I understand your question here. I think it's impossible to know because we have no idea what they're paying in debt. We have no idea what their capital stack is. We have no idea how much their equity costs. So we really don't know. And honestly, it's not really something that we look into because it doesn't drive the conversations at all. We look at the price tag, and if it's one that we can pay and that we're good with and we can hit our returns, it really doesn't matter to us how much money they're making.
How likely is the 5-year time frame for the sale? Exactly 5 years, extraordinarily unlikely. Yeah, so exactly 5 years, very low. 5 years is a good target. It is the balloon of our long-term debt typically after our IO period, so it gives us a year cushion. But we stick to 5 years because that is a good 18 to 36 month buffer of us being able to complete our business plan. Our whole strategy here is to make sure that we can increase the value of the property through our multiple value add strategies. And once that's done, we want a year of history, and then we want to take that and we want to sell it. Either into a stabilized fund that Spartan manages or to a stabilized ownership group that has access to capital that is way beyond anything that we could ever value the property at. So this is a value add investment. Once the value add is complete, we've got enough historicals on that value add, we're going to want to exit this particular security. Arun is asking, when is the investment amount due? It is based on a first come, first serve basis, but I do not know what the trigger for the placeholder is. Ted, do you want to speak to that?
So yeah, so we've got currently we've got about $3 million left on equity and maybe $6 million left on debt for room to go. We invite people to subscribe, and then if you don't want to move forward, you can cancel your subscription. If somebody subscribes but does not deliver funds, another person could subscribe a few days later and bump the first person if they provide their capital. So it's first come, first serve. I will say this industry feels to me a lot like the banking industry in the 80s and the 90s when it went through a consolidation. There is always another car. There's always another house when you're shopping for one of those assets. We will find more storage assets to tinker with. So don't get in a hurry, but at the same time, if you've got money to place, make a 2% of your net worth or a 6% of your net worth bet and tie your wagon to our horse.
All right, well, I want to thank everybody for being on the call, and I want to encourage all of you to reach out with any additional questions and join us for the Southeast Affordable Portfolio. Thank you very much.